Good morning and welcome to Financial Strategies with Scott Wardell. While various products may be discussed during the course of this program, please note that these discussions are intended only to educate you about financial topics. They are broad in scope and do not consider your individual personal financial situation. You should work with a qualified financial professional in collaboration with your attorney and tax advisor before implementing any financial decisions which will affect your personal financial situation. Thrivent financial representatives cannot provide legal or tax advice. Your local Thrivent representatives are Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731. And now, Financial Strategies with Scott Wardell.
Welcome into this week's edition of Financial Strategies with Scott Wardell. It's going to be a beautiful string of weather next week. Looking forward to this Indian summer
the
almost.
Colors in the trees and the sumac are just spectacular this week.
Aren't they?
And of course the fields now have gone to just a beautiful golden color, so it all matches. Oh, I love this time of year.
Perfect for apple picking, probably.
It is. It's absolutely spectacular for apple picking.
Just trying to throw a little promo for you there. So how are you today, Scott?
I'm doing great.
Good.
And how are you, Scott?
I'm doing very well, thank you.
And we have a great guest with us here today. We have Todd Yider, who is really a risk management specialist. And Todd, thanks for being with us today. So appreciate you taking the time to spend a little time. And today, the topic is wealth transfer, as you see. But the first thing we've got to let our listeners know is wealth transfer is not necessarily for the wealthy. Is that right, Todd?
That's exactly right, Scott.
And we're going to go into a little bit of what wealth transfer is. But there's a couple things I want our listeners to really pick up out of today's show. And first of all is, let's face the facts, is that almost everyone is going to have part of their wealth or savings, let's just call it savings for the time, transferred to somebody else at some point in time, either while they're living or after they're gone. So today's show, we are hoping that they pick up a couple of great ideas on how they, whether or not they should wait and pass it through their estate, and what are some things that they could get started on way before even estate planning in order to make certain that their heirs and people that they care about and charities, so we got really three groups of people, might be able to participate in some of their hard-earned savings that they've accumulated over the years. Is that pretty much it?
That's right, spot on, Scott.
Okay.
And if I remember from previous weeks we've talked to, there are a lot of tax implications here, correct?
Absolutely, lots of tax implications, and we're not going to get into any tax advice, of course, but what we're going to do is give the general landscape.
Right.
That people have to consider. So I think they're going to get a lot out of today's show. So Todd, tell us, what is wealth transfer? And again, don't want to scare off those folks that are listening that are like, hey, I'm not wealthy. It's not about being wealthy. But what is wealth transfer, and how does it relate to estate planning?
Well, that's it's an interesting point. You and I were talking about this, Scott, that when people think about wealth transfer and estate planning, they think about the mega wealthy.
Right.
And really, this isn't for the mega wealthy. It's really for just about everyone.
Right. And the clients that I work with all the time, people that are just as, common as can be, we use a lot of the techniques that you and I are going to be talking about here today.
Yeah, it's all about leaving your legacy, all your assets based upon your goals, your values, to who you want, when you want, and in the manner that which you want to leave it. There was Scott, we were talking earlier, there was a story that I had. I was doing an estate planning seminar a few years back, and before the seminar began, we had a conversation with a number of people. These are mostly farmers. And I heard one of the guests say, well, I didn't receive a whole lot of money when my parents passed away. And if I just leave a bunch of money to my kids, they're just going to blow it.
Right.
And so I asked, well, if there was a way.
They might be right, by the way.
Well, it could be. In fact, I think some of the statistics state
more often than not. So, yeah.
Some of these people really do blow the money within a matter of weeks. But here's what I asked. I said, if there was a way that you could leave your assets, your legacy, in a way in which maybe you're helping your next generation, your kids, your grandkids, your great-grandkids,
right,
maybe plan for college, maybe start a business, and sprinkle those dollars out over a number of years, would that be something of interest to you? And they came back and said, well, is that possible?
Right.
Well, sure. That's one of these things we call incentive-based trust, and it doesn't have to be for the big wealthy individuals. If you're going to leave a legacy, why not leave it based upon the terms in which you want to leave it.
Absolutely.
So that was a neat idea.
You know, years ago, Todd, there was a gentleman in Mankato who had set up a trust where he said, this trust shall pay equally to my two sons the amount that they can produce on either a 1099 or a W-2 every year. Now that's incentive trust right there that says, well, and of course it had a cap because if they went out and, you know, made tons of money, it wasn't going to match everything. But as you know, one of the things that people worry about with giving money and actually having it pass through their estate to children is that it sometimes spoils them. It spoils them in a way that they lose their other incentives. So if you do incentive-based trust, of course, then it's actually trying to do the exact opposite thing. How do we go about creating some incentives for people? Now, that and trusts, of course, aren't for everyone either, because it might you might have a size of a state where it's large enough, or there's some complication, there's some things. But for our general listeners, we're going to be talking today, of course, about some of the really easy to do things, right?
Right, exactly, and things that could help minimize taxes, provide a lot of liquidity. So, you know, what happens if, well, I need this money while I'm alive? We don't want to impact the person's current standard of living.
Right.
So how do we give them an out while they're alive and potentially in retirement?
Right. So Todd, I think that's a good place for us to start, because I think that families and people really create in themselves a willingness to start giving or start putting a plan together once they've determined they have enough for themselves. So let's take that point. Let's say a family's determined that they're not going to use everything they've got during retirement, and of course that can take a lot of planning. We always say when we work with clients that it's kind of like the spiel that you get when you're on an airplane. You know, when they say in the event that the cabin becomes depressurized, an oxygen mask will fall, put yours on first. Well, money tends to be a little bit like that as well, because no one wants to end up being the victim. You know, you can't help others if you're a victim. If you're not a victim, you can help others. So let's start with that point and say that if someone's got to that point where they know that they're not going to be using all the money for themselves, what strategies would you say that they should consider for this kind of transfer, savings or wealth transfer?
Well, one of the things that I like that you said, Scott, is that they're planning for that unexpected event. So first of all, there's things that could potentially go wrong for the client. They could become too sick or hurt to actually take care for themselves. There could be potentially a hiccup in the marketplace. Think of the financial marketplace that we had just recently. There's a few ups and downs.
Right. This is a case of hiccups that won't stop. You ever have one of those where you're like, okay, I'm holding my breath. I'm trying to get the hiccups to stop. That's what this market has felt like.
It sure
just
has.
Won't stop hiccuping.
So you've got to make sure that you have an out, that you have that liquidity taken care of. Now, once that's all been addressed, then you can look at, there's really three different things you can do. One are gifting strategies.
Right.
And gifting could be to people or it could be to places, kids, grandkids, or church or charity. And one of the neat things about gifting is you can enjoy watching the people or watching the places enjoy the use of those gifts.
Right.
The downside with that, of course, is it's a gift. Once you give it away, you can't
get
it back.
It anymore, right?
Right. So that's one way that you can look at it. Of course, there's the legal arrangements as well. You and I were talking about the trust that you could set up. Another thing that probably every one of our listeners should have at some point in their lives is a will.
Right.
And that's one of the things that people they procrastinate and don't put in place until it's almost too late.
And for our young families, just a note for the young families. Once you have children, you need to get a will. I mean, it's not, I put this in the category of non-negotiable. You have children, you go get a will, because the will is the document that says who's going to take care of your kids if something happens to you. So you and your wife go out, get killed in a car accident, you're both gone. You have to have that in place, because you don't want to leave the other families in some kind of dispute over who's going to take care of your kids. So sorry to interrupt you, Todd, but that's a really important piece.
It's huge. I've got two little girls back home myself, and it's very important to me, should something happen to me and my wife, that those girls are taken care of.
Right.
And setting up a will, people are afraid that it's going to be really complicated, really hard, really expensive, and it really isn't. So important to have that.
And in today's world, people, when they get the wills, they typically get it packaged along with a couple things. A power of attorney. And a power of attorney, all that does, folks, is that says that in the event that I become incapacitated, who can transact business on my behalf. So that's a necessary piece. And then, of course, in today's world, the medical directive. And most attorneys package these three things together. So we highly encourage people to see a legal professional, especially one who specializes in estate planning kinds of issues, to get this done. Absolutely.
The third way that we can look at gifting strategies is actually through products. And sometimes people forget about this. Your investments, many of the investments that are out there today have this transfer on death. It's kind of like a beneficiary for investments. Neat thing with the investments is, for a lot of those investments, when you pass away, they get what's called a stepped-up basis. So there's less taxable gain to the heirs. That's one way. There's also products such as annuity contracts that have tax-deferred growth and passed by a beneficiary arrangement to the kids or people or places.
Right.
And then, of course, there's life insurance. Now, life insurance you have to qualify for health-wise. The neat thing about life insurance is it can pass through the beneficiary arrangement, and if it's done properly, may avoid income taxes and potentially other taxes.
Right, exactly. And one thing, because people confuse this all the time, is they don't realize that what you put as a beneficiary on an account, so whether it's payable on death, transfer on death, or a named beneficiary on life insurance annuities, that none of that is controlled by your will. That it is controlled by that named beneficiary on those particular accounts. So part of our job as we sit down with clients is to make sure that these things are coordinated in some fashion. So that's why when people sit down with us and we say, well, how is your will set up so that we can make sure that if you're going to put a beneficiary, let's say on your IRA, that you've got some connection or some coordination is probably the best term between those things, between what your will says and what your and what your named beneficiary piece is.
Exactly. And Scott, I just want to put a plug in here too for the beneficiary arrangements. So often we'll set up these financial instruments, we'll set up the beneficiary designation, and we forget to update them.
Right.
I actually just went through my own personal ones, and my brother, if he's listening, he's still on one of my insurance products as the primary beneficiary. It's not going to my wife and kids should something happen. So probably should get that one updated.
Absolutely. And we had a case this year where there was a client that had been assigned to me, frankly, and I had not been able to meet with this client, and they just had a small life insurance policy. It's all it was. And so I said, well, if nothing else, we need to do a review of your beneficiaries. And for all our listeners, this is really an important thing, because I could see just by looking at the contract that this contract was taken out when he was a child, in fact, an infant. Well, it was still, in existence and still provided a death benefit to somebody. But what he had done is he had named his parents as the beneficiary. Well, he didn't name them. They named themselves, of course, because he was an infant. And nothing had been changed on that. So we had contacted him many, many times to try and get him to come in to do it. Well, in early this spring, we called and his cell phone to try one more time, and his wife answered, and he had died. And so now he had his life insurance going to his parents, which, by the way, were also deceased.
Oh, my goodness.
So we had to unwind and get it down to the ultimate beneficiaries, which in this case were other family members and not his wife and his kids. Yeah, exactly. So, when we talk about wealth transfer, one of the things we've got to really be clear on is whether it's a transfer that occurs at someone's death or in their lifetime, that it is a clear pathway. That it's not, like, well, here's where I want it to go. Well, does the document lead the money to that right person? It's really important. So,
absolutely.
And I know people think about that like going to the dentist. I don't want to do that, but it's one of those things that every now and again you really need to do.
Sure. Now, Todd, you mentioned a moment ago income taxes, and we talk about income taxes a lot. But what about something like estate taxes? What should a donor consider in terms of estate taxes?
Estate taxes, right now with the federal government, there's this arrangement where if the estate is $5 million or less, you pretty much can avoid estate taxes from the federal level. But there's also state estate taxes. Here in Minnesota, we have those state estate taxes. And sometimes what you can do is look at gifting strategies or moving your assets outside of your estate through these gifting strategies, so they're not included in those calculations when you pass away.
Right. And so with, Todd, with the 1 million Minnesota kind of exclusion, and again, when we talk about these kinds of issues, we really encourage people to go sit down with their attorney and their tax professional and figure out what's going to be the best situation for themselves. But just one of the things, that $1 million is per person. So if a couple sets up their estate in a way to maximize that, then a couple can pass $2 million. But what we see so often is that one couple, one part of the couple wills everything or has joint tenancy in such a way that it all goes to the survivor. And then that survivor ends up with an estate that's over $1 million. And people say, well, that sounds pretty wealthy. Well, you know what? Look at what's happened to the price of farmland. It doesn't, you get past the 1 million mark really pretty quickly if you own any kind of real estate and farmland. And so I just want people to understand that if they take the time and do that planning, they have the opportunity, and I emphasize the word opportunity, to pass as much as $2 million tax-free to their heirs if they split it up correctly.
Well, pause for just a moment. This is Financial Strategies with Scott Wardell. We're talking more about wealth transfer when we return.
How would your financial life improve if you changed just one thing? Avoid ATM fees, make your gifts rather than buy them, protect yourself from identity theft, save more for your family's future. The list goes on. If you heard something today on Financial Strategies that motivates you to change one thing in your life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing. Think about your finances, your lifestyle, your wants versus your needs. What one thing can you change today and see the impact tomorrow? Perhaps your family will save all your change for a month and donate it to charity. Maybe you'll finally write a will. Whether you choose to start simple or take a big step, that one thing can really make a difference. If you heard something today on Financial Strategies that motivates you to change one thing in your financial life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing.
Welcome back to Financial Strategies with Scott Wardell. Thanks for joining us this week as we talk a bit about wealth transfer with Scott and his guest, Todd.
Yeah, and Todd, again, thank you so much for being on the show here with us today. So we've really been talking here right before the break a little bit about the income, the estate taxes that people might consider, at least the size of their estate that they might be able to pass through. So let's get into the next piece here. What's the connection between these types of strategies, that being gifting and how they set up their wills or trusts? What's the connection between that and people's overall investment plan? How do they fit?
That's a good point. You have to make sure that whatever you're putting in place, you look at the bigger picture, the overall financial plan, the overall investments. Because, I'll give you an example, if we're looking at some particular products that have a lot of guarantees, when you add those guarantees into the overall mix, a person might be able to get a little bit more aggressive with their investment allocation. The other thing, Scott, we talk about when it comes to investment strategies, we also often talk about diversification.
Right.
Looking at potentially a different mix of stocks and bonds to get us a better return for potentially less risk. Yet there's another way to diversify as well, and that's based upon taxes.
Right.
And really, taxes come down into three different buckets. Those vehicles that create taxes each and every year as they're growing.
Tax now.
Yep. The second is those vehicles that are tax deferred now, but at some point somebody someday has got to be paying taxes on the growth. We call that
tax later.
Tax later.
And of course, that would be IRAs, 401ks, and of course with what we call non-qualified annuities, that would be an annuity that's not in an IRA, 401k, 403b, any of those kinds of things. You got the growth that's taxed later. So yeah,
exactly.
Okay.
And in that last bucket, we call it income tax-free. These are vehicles that are growing tax-deferred, and if we structure them properly, pass on to the next generation free of income taxes. And there's a number of vehicles that actually could be used there, from life insurance, potentially, in some cases, municipal bonds and
Roth IRAs.
Yeah.
Yeah, exactly. And in some weird circumstances, and again, that's why we encourage people to see their tax advisor to make certain that, for instance, your example of municipal bonds. Municipal bonds are tax-free for the most part for most people, but there's some, weird circumstances where they actually are not completely tax-free to people. So again, see your tax advisor on those, particular kinds of issues. But yes, you're bringing up a great point here, Todd, is that, and we call this part of the 3D diversification strategy.
Yep, exactly.
That says, yeah, you've got to have exactly what you said, that split between the income assets, the growth assets, but then you start looking the other way and you say, now let's take a hard look at what taxes, how taxes might affect this. And then, as you know, we have to start thinking about, what happens to those tax later when it passes on to the heirs.
Kids get a big tax bill.
Exactly. And I often ask my clients as I'm sitting down with them. I had this very thing happen this week where I was getting acquainted with a family. They were talking to me, the husband and wife were talking to me about their kids and their kids' jobs. And the kids were pretty much all professionals in some, perspective. And I said, well, it sounds to me like it's likely that your kids are all in a higher tax bracket than you are. And they looked at each other and they thought about this and they said, well, 4 out of 5 of them are. One of them might not be. So, well, now you have a different kind of tax deferral strategy. Because remember, here's, the whole basis of tax deferral is when you can take tax deferral and tax deductions for that matter. If you can take a deduction in a higher tax bracket or defer while you're in a higher tax bracket and then take the money out while you're in a lower tax bracket, guess what? You win. On the other hand, if at some point in time now you might be collecting Social Security, your income might be reduced, and you might not be as in a high tax bracket as you were in earlier, but you look out on the horizon and you say, hey, this money's going to go to my kids. And then, of course, you got that issue that now you're actually, in a way, deferring from your low tax bracket to potentially their high tax bracket, right?
Exactly, and that's why you want to have that balance. One of the things that a lot of people are concerned with right now is what's going to happen with taxes in the future. If we are asked most people about where do you think tax rates are going to go in the future, chances are most people would say higher.
Right.
Though we don't know.
Right.
So if you have money in each one of those buckets, you have options.
Absolutely, yeah. And so many people today, because if they're working for a company, their predominant retirement savings are in 401ks or 403bs or some kind of deductible thing. I run into a lot of cases where the majority of their non-real estate wealth is really inside of that tax later bucket. And one of the things I do is I ask them, I say, okay, let's just for a moment fast forward, you're in retirement. And as you're retired, you say, you know what, it's time to trade cars. We want to get a new car. So you say, let's call up Scott and see where's the best place to get some money to get a car. And you come in and you see me and you say, okay, we found this car and it's going to cost us $26,000. And where should we get the money from? And I go through a series of, well, if you take it from your qualified plan, your IRA, your 401k, or whatever it is, you'd better take substantially more than 26. As a matter of fact, my calculation might be 36,000. And the couple would say, why so much? Well, you got to pay taxes on all that money as you withdraw it, and so you want to end up with a net amount of $26,000 in order to buy that car. So in terms of what it takes from your assets, you got to think of 36,000. Wow. Okay, now, if you go down this path of 3D diversification, as you're talking about, Todd, then, and if you have that bucket of tax never money, and again, we're talking income taxes here because I don't, as our listeners are thinking about this, I don't know the size of your estate, so I'm not saying that it's not going to be affected by estate taxes, and if you've got a Roth IRA sitting out there, the chances are you're going to be able to take a withdrawal from that and pay no taxes on it whatsoever, and so your $26,000 car costs you $26,000 of savings and wealth.
Rather than 36,000.
Rather than 36,000. It's a much fairer deal. So that's why one of the, just a little story to kind of illustrate why we like to use this kind of strategy.
Yep, exactly.
Okay, so Todd, let's get into, you said one of the three things that people use to do this is life insurance. So you and I both know that it happens a lot where when people retire, they let their life insurance lapse. Now, they might let it lapse because it was part of a company plan, and that's all the life insurance they had, and when they retired from the company, the life insurance just plain disappeared. So it wasn't intentional. But on the other hand, some people say, well, you know what, honey, the house is paid for. We don't really need that life insurance anymore. So, talk to us a little bit about, what they should consider when they're doing a life insurance review and what they actually might need some life insurance for while they're retired.
Scott, I love talking about this because so many times when I talk to individuals, they say, well, why on earth would I need life insurance or want life insurance into retirement? Yeah, there's a number of reasons why life insurance may make sense in retirement. You mentioned one. A lot of people today, unfortunately, are relying on their life insurance provided by their employer.
Uh-huh.
And what happens when you leave employment? Generally speaking, that life insurance leaves as well. Interesting trend is happening in the industry right now. Life insurance sales in general have been really low. In fact, life insurance ownership last year, this is from LIMRA, was individual life insurance ownership was at a 50-year low.
Wow. That's a little frightening.
Well, it's scary because it's something like, of those, something like 40% of households in the United States right now have no life insurance other than what they have through their employer. Yet the interesting thing is, where life insurance sales have been growing have been at the age 60-plus crowd.
Right. I can see why that would happen, as a matter of fact. When you think about it, and so much has been said about this instant gratification generation. But in order to buy life insurance, there's a couple things that have to click in your brain. Okay, one is, this is not for me. It is for my family. It is for someone else. You do it for others. Now, and I know you're probably going to talk a little bit about access to it for me. So and that's a really good thing. But the other thing is, it is not about today. It is about something very far into the future. So people who are living for me and living for today, it's very, very hard for them to think about how life insurance might really come into a broader, longer view of their life and now their legacy.
That's a very good point. The younger generation, you have so many other bills that have to get paid for. The kids' braces, college education,
Absolutely.
Everything else. My girls are smiling with their braces on right now.
Right.
The other thing is, when people get into retirement, they realize, number one, there's still income that's dependent upon them just simply waking up in the morning.
Absolutely.
Scott, people forget, for a couple, most couples, upon that first death, anywhere from 30 to 50% of that Social Security income is gone.
Right. You're going to lose one of them or the other.
Yeah.
You're going to either lose yours or your spouse's, depending upon which one is the smaller of the two. Right.
The other thing is what I see is that the older the people get, the greater the desire to leave something behind to the kids. And people love their kids, yet they go wild about their grandkids. They really want to leave something there. I see that in my own family.
Right.
So the biggest thing is, though, if you haven't planned for that earlier on, people will get into retirement. Now they want to get a life insurance policy. Can they qualify health-wise? And, as you get older, the life insurance policies get more expensive.
Right.
So I guess if there's feedback I would share with our listeners is, take a look at this as an option. Take another look at this as an option the earlier you are, because the sooner you get that in place, the more options you have in the future.
Absolutely. And also, if they have a term kind of policy, which a term is, very specific to, it covers you for a period of time, a 5-year, 10-year, 15-year period of time, that they might have a policy that has a feature where they can convert it to a permanent kind of insurance. So conversion features are something that people don't understand and they rarely use. And it's unfortunate, because if they'd understood that, many times that when they get to close to retirement and they've got that big term policy, which is usually part of good life insurance architecture, to get that piece that covers you in that period of time that you need it the most, that they might want to take part of that and convert it.
Absolutely. It's a good point.
Now, there are also a lot of ways that people can explore life insurance into retirement. Todd, what do you think? Or Scott, what should people watch out for?
Well, a couple things, and Todd, I'm really interested in your point of view on this as well, but one of the things that if a policy has very long and very large surrender charges, I'm going to explain something to our listeners. If you have a large and long surrender charge, that means that it's very likely that the person who's offering you that policy gets paid a pretty good commission. So it is almost always the way in which a company covers the costs of issuing that policy up front. And the fact that they get paid a large commission doesn't make it a bad thing, but if you're going to go into it with your eyes wide open and you are in retirement and someone is offering you a policy, and boy, it is 6 or 7 years until your cash value is back up to any kind of par level, then I would be aware of that, because there's other kinds of life insurance that are, I would say, more efficient than that and don't necessarily, and it's more really honestly about serving the client's goals and not so much about the large commissions. And no, I say that, and there are certainly situations where those other policies work, but be aware of that. If there's a large or long surrender charge, you got to be aware. Another thing, interest-sensitive contracts that could potentially go upside down if interest rates fall. So almost every life insurance policy has to, and the illustration has to show a guaranteed side. And you have to look at both the guaranteed and the non-guaranteed and the rates that are projected. If there's one thing that I hope people learned about life insurance back when rates are high is 8% is not sustainable. So if they went into a life insurance contract and it was projected out to earn 8%, it's probably underwater right now. So that's another thing. They have to, if they're going to have a meeting with that professional, with whether it's an insurance person or a financial planner, be aware of that. And now I'm going to tell you bias. Okay, so Todd, slap me on this one, okay? But variable life insurance contracts that have equities in the cash value. This is a kind of contract that, frankly, instead of putting it in a fixed kind of account, people can invest it into stocks of all sorts, small cap, large cap, mid cap, all these different kinds of stocks. It makes me crazy, Todd. I'm sorry. It makes me crazy, and I'll tell you why, is because, we've got this wild fluctuating market, and you look at 2008 and you see your cash value on these variable contracts drops in half, and it's fine if you're quite young, they can work out. But for older people, when they need that cash value to actually support the policy, and all of a sudden the market goes down and the cash value goes down, it's sort of the antithesis of why people usually buy life insurance. So there's my bias. I got it out there.
Let me just share my side of this. And Scott, actually, I agree with you. For people that are, what I say with the variable products is that if you're 50 years old, or call it 55 years old or older, generally these are the ones you're going to probably want to stay away from. Yet I have VUL, a particular variable life contract on my daughters. They have longevity. They have the risk tolerance.
And they're what ages?
Well, it's 12 and 7.
Okay.
And I have one in my life, and I'm in my 40s now.
Okay.
You can also, there's some products out there that have a fixed account that can be used to cover what we call the cost of insurance, so it can add some stability. And what's really important, Scott, is how people are funding them, because these products don't necessarily have a set premium. Yep. And so the more money you put into those contracts, the greater the stability. But it's not for everyone, and I certainly want to suggest this for people that are going into retirement.
Right. Okay, good. Good point of clarification. And, at the beginning of the show, they always say the opinions expressed today of Scott Wardell and his guests, and not necessarily the opinions of Thrivent Financial.
Exactly.
This is why, because sometimes we just lay it out there.
Yep. More on wealth transfer on financial strategies with Scott Wardell coming up next.
Nearly 3 million members look to Thrivent Financial for Lutherans to help them achieve their financial goal. Nearly 3 million people know that Thrivent Financial is committed to excellence in financial services and caring for others. Get to know Thrivent Financial and the quality of products and services they can offer you. In Minnesota, you have a host of representatives to help you with your financial needs. Contact your local Thrivent representatives Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731 or call 1-855-346-4332. Registered representatives for securities offered through Thrivent Investment Management Incorporated, member FINRA and SIPC.
Welcome back, and thanks for joining us this week on Financial Strategies with Scott Wardell and our guest in studio today, Todd. We always have a weekly special, a kind of free offer. Scott,
Absolutely.
What do you have?
And I really highly encourage people to call in to get, I'm going to offer 2 booklets today. And the first one is called The 5 Foundations of Income Distribution. We were talking a little bit earlier about the connection between investments and the risk management pieces, and most of our conversation we were talking about life insurance, but 5 Foundations of Income Distribution, and a second booklet called Cover Your Bases. And the byline on this one is to focus on protection planning while helping achieve retirement goals. That's what that particular piece is called, Cover Your Bases. And if people call this number, so if you've got a pencil in hand, write this down. You just have to leave us a message and we'll send it out in the mail to you. It is 1-855, that's a toll-free number, by the way, 1-855-346-4332, and we'll put both of those pieces in the mail to you. Make sure that you leave us a name and an address so that we know where to mail it to, and these are educational pieces that I believe will help people kind of sort out some of the very issues that we're raising here today.
It's a 2-for-1 today.
It's a 2
or
for
2
one.
for free, technically.
2 for free.
2 for free.
2 for free, exactly. So, okay, so we've been talking here about wealth transfer, and we've been talking about protection, and as Todd, we've been talking about life insurance as a form of protection. What kind of protection can someone get who's not insurable?
Great question, and that's one that comes up a lot, particularly as people get older. There are some products out there, Scott, annuity products, that have different what we call death benefit guarantees on there.
Sure.
Most variable annuity contracts have what's called a basic death benefit guarantee, and if something were to happen and the person passes away and the market's at a low point,
right,
they're at least assured that they get what they put in, they get that back.
Right.
Other products have more fancy death benefit guarantees, and you pay for those.
Sure.
Yet some will cap at a high water mark, so if the market spikes in a particular year, it will lock in that spike. Other death benefit guarantees can actually allow the value in that account from a death benefit standpoint to increase at a nice gradual slope year after year after year up to a particular cap.
Right. Okay.
Regardless
of the account value, that they will do that.
Exactly.
Right.
So, look at what we've gone through over the past 10 years. Some of these products would actually have a much greater death benefit than what they have in cash value. Some of the products, some of our listeners may have these products already in place and forget they even have them.
Right.
So it's something to take a look at.
And most of their statements will provide 2 numbers on it, the death benefit guarantee and the value of the account itself. Exactly. And it's really important that they understand the particulars of their contract, because as you're talking through these particular issues, these things have been written in a multiple of ways, and sometimes they even expire. I've seen some where all of a sudden that particular death benefit guarantee might either be capped or expire at age 80. So, this is where I love to, really dig into the policies that people have and say, let's read this thing together and figure out what it has, what the particular features of it are. So, again, consult your professional on this. I'm guessing that most people don't have an intimate understanding if they own annuity contracts, or even if they own life insurance contracts, what the things really do for them, and maybe what they don't do for them. What are the little tripwires is what I call them.
Very good point. Make sure that you're having those conversations and finding out what it is that you have and what you don't have.
Right. Now, and to our listeners, of course, this is one of those things in that category of, that doesn't sound like much fun. and you know what? It's just one of those necessary things that every now and again you sit down and you do a deep review and you go into those contracts and say, here's the way I would put it to you. If you're paying for it every month or every quarter, understand what you're getting or what you're not getting.
You know what? It actually could end up being fun if you find out that you thought your annuity contract had a real low value and you're depressed about it, and then you find out you have this death benefit guarantee that you had forgotten about.
Right.
It may brighten your day a little bit.
Yeah, except for Todd, you still got to die to get it.
Oh, that's true. Good point.
That's hard to brighten your day. Okay, good. Well, Todd, for someone who's, let's change the channel a little bit here, or our direction. Someone who's looking to provide a benefit to a charity. Okay, so we've been talking a lot about protection of the family, transfers to the family. What do you think they should consider when they're investigating some of the wealth transfer strategies that we're talking about, some of the savings transfer?
If you're looking at leaving a gift to charity, one of the things you're going to look at is, do I want an income tax deduction or not? Give you an example. If I want to get an income tax deduction for this gift to charity, then it has to be what we call a complete gift. I have to really give it away.
Right.
But there's some other easier ways of doing that as well. For example, one of my life insurance policies, I could actually name my church or charity as one of the beneficiaries.
Right.
I don't get an income tax deduction for that, yet I have complete control over that. If the church upsets me and I want to change it to a different church, I could do that, or a different charity, I could do that. Don't get an income tax deduction, though I still retain that control.
Right. Okay. Good. Now, and I have to add something there because, of course, most, whether it's a church or any other kind of charity, most of them are tax exempt. In order for us to get any kind of deduction, they actually have to be covered under some tax exempt code, right?
Yep.
And so within that, one of the things that people should also consider is giving away, as you were talking earlier, that bucket of money that is taxed later. Because if you were, in fact, going to give X amount of dollars, say that you looked at your estate and you said, gosh, I'd really like my charity, my favorite charity or my church to get $15,000, let's say. And you look at all the different places that they could receive that from. If they received those taxed later dollars, part of your IRA or 401k, as a tax-exempt organization, they don't have to pay tax on receiving that. They don't have to pay the income tax, right?
Yep.
Okay, so the other half of that, of course, is that if they give that to their kids and heirs are taxable entities. So they would, in fact, have to pay tax on receiving that. So when those choices are laid out for clients, what they often decide is, I want my kids to get the tax-free dollars, I want my charity to get the taxable dollars, and then for the most part, no one will have to pay any income tax on the receipt of that. And of course, again, see your tax professional. We're just giving this as an illustration, so you have to figure out the particulars.
Right. Todd, it wasn't that long ago that government bailouts were going to these big insurance companies. I think it's made people a little leery. What do you recommend that they know about an insurance company that they're dealing with?
You know, that's one that comes up a lot when I'm talking to my friends that are not part of the industry. There was a big insurance company that got a bailout, so it makes it kind of taints the entire industry. The reality is there weren't a lot of insurance companies that actually received government bailout dollars, although there were some very, very large ones.
Right.
When you're working with an insurance company or any financial institution, you want to make sure that they're strong and stable. In the insurance industry, there's these rating agencies. There's three of them that I would mention are AM Best.
Right.
AM Best really focuses in on the insurance industry. There's Fitch, and there's Standard & Poor's, and there's also another one there called Weiss. When you look at those institutions that have the highest ratings from a number of those, these companies have done some really deep dive into their financial statements, looking at how much debt they have on the books and how much money they have in reserve to pay all these death benefits that they've promised for generations to come. So it's really important to actually look at those ratings from a couple different agencies.
Right. Well, and I think the bottom line is that even though that there weren't that many companies that received the actual bailout, it did all of a sudden kind of open up this whole perspective of some companies weren't quite as strong as what they had maybe led people to believe, or at least that the public believed. And so I think it's really important, as you're talking about this, that people actually look at the strength of the company that they're working with, because I'm not trying to prognosticate. There we go. I'm not trying to prognosticate the future here, but I would say if we may be headed over the next few years for some fairly rough waters. We're certainly not headed for smooth sailing. That means the strength of the company that you're dealing with is really, really important, because companies that are marginal now, boy, I don't know. I don't want to go into rough waters, with a boat that's not 100% secure. You want very, very much to have a strong company on your side. So that's something that people don't investigate that much, and they really should.
These companies are making promises that could be 80 years or longer. And the interesting thing here, Stephanie and Scott, is bigger isn't necessarily better.
Right.
Sometimes your best, their strongest insurance companies are actually a little smaller than you might think.
And it really comes down to how well they're managing their general account, the account that backs up their promises that they're making.
Exactly.
Yeah, so I encourage people to look into that, and that's more than people are usually looking into, but at least ask the question, give me the ratings of your company by 2 different agencies. It's that simple.
Every company should be able to provide that.
Absolutely.
We're talking about wealth transfer on Financial Strategies with Scott Wardell. Today, a little more on gifting and life insurance when we return.
How would your financial life improve if you changed just one thing? Avoid ATM fees, make your gifts rather than buy them, protect yourself from identity theft, save more for your family's future. The list goes on. If you heard something today on Financial Strategies that motivates you to change one thing in your life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing. Think about your finances, your lifestyle, your wants versus your needs. What one thing can you change today and see the impact tomorrow? Perhaps your family will save all your change for a month and donate it to charity. Maybe you'll finally write a will. Whether you choose to start simple or take a big step, that one thing can really make a difference. If you heard something today on Financial Strategies that motivates you to change one thing in your financial life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing.
Wealth transfer, our topic today on Financial Strategies with Scott Wardell, and guest in studio today is Todd. Thanks for joining us this week.
Thank you.
I really appreciate your insights here, Todd. And I want to give our listeners yet one more opportunity to get the free offer of this week.
Yeah.
So if they'll call this number, again, if you didn't catch it before, here it is. It's 1-855, that's a toll-free number, 346-4332. And we're offering 2 things today. So all you have to do is leave your name and your address, and we'll get it mailed out to you. Now, it's also actually helpful if you leave a phone number, because I know in the last week there was a couple that we had to call back because we actually couldn't find the name for mailing. And we had it misspelled, frankly, because it sounded, in this particular case, the name was spelled with a Z in it, and we thought it was a C, and so we just had to get that corrected. So leave a phone number, too, so we can check it out. But the 2 offers are, number 1 is a little booklet called 5 Foundations of Income Distribution, and number 2, because we're talking so much today about protection planning, it's called Cover Your Bases. And Cover Your Bases has a byline. It says, focus on protection planning while helping achieve retirement goals. That's what the byline on it is. I think these are both really good pieces for people to take a look at. And it is about, as we started this show, we said we're going to help people pay attention to important things in their financial life, but we're also going to provide some good information for them. So call that number in. Hopefully that will help.
Yeah.
Okay.
We mentioned at the beginning of the program, just touched on gifting as a form, I guess, of wealth transfer. What sort of general gifting rules would you recommend, Scott, that investors should know about?
Well, to start with, people are individually limited to $13,000 per year. And again, here's where we say, see your tax professional when you're going on one of these strategies. And what we like to do with our clients is we like to actually often get the tax professional on the line as we're discussing these strategies. So often just conference them in for 10 or 15 minutes to make sure that we are in concert with the other financial professionals that any client might be working with. But $13,000 per person means that my wife and I together can give away $26,000 to any individual. And then if we're giving to a couple, we can double that once again, and get up to the $52,000 if that's what we wanted to do. But remember, folks, that's the limit before you have to file a gift tax return. So you can give substantially less than that and not worry about it at all. Well, you have to worry about it from the standpoint of making sure you've got enough for yourself. So there is some concern there. And of course, then there's also a $1 million lifetime exclusion. But again, that doesn't mean you wouldn't have to file a gift tax return. You would. And there's no limit to charities except that if you start to give great amounts to charities, you might lose the current tax deduction if you go over another limit, and that's 50% of your adjusted gross income, kinds of things. Again, see your tax professional. Now remember, on a gift, one other thing that we've got to put on here is that the cost basis is the same as the donor. So my example is, if I own a stock or a mutual fund, let's say, and I put $10,000 into it, and I've gotten $5,000 of taxable dividends over the last few years, my cost basis is now $15,000. If I give it and it's worth $20,000, then the recipients of that gift take on my cost basis. So they take on the $15,000 cost basis. And so if they ever sell it, they're going to have to pay tax on everything above that $15,000, probably at a capital gains tax. Now, if I leave it to them, and you mentioned this really early in the show, through my estate, they'll get a stepped-up cost basis. And I promise you that the IRS is tinkering with this as well, and so is Congress. So what I'm going to say here, again, check out with your tax professional. But for the most part, then they get the new cost basis of $20,000. The consequence of that is no taxes paid on that particular gain. So it's a lot more detail than, maybe people are interested in on the radio show, but it is the kind of detail where when we start doing a financial plan for them, we have to consider these items as well, because of course taxes tend to be a pretty big part of an overall conversation about how you manage your finances. So
absolutely.
Those are kind of the main pieces there. Todd, anything that you would add to that?
I think you hit it right on the head, Scott, is make sure that you're working with your tax and legal professionals as well to make sure that you navigate all those different hurdles.
Absolutely. Now, and Todd, as you know, that there are some life insurance contracts, because we've talked a little bit about life insurance today, that are interest sensitive. So if someone has an interest sensitive, and I'm not talking about a variable kind of contract that is in stocks and bonds, but just a standard, mostly in the category of universal life, how often do you think they should have those contracts reviewed?
Excellent point. When I was a little kid, I grew up wanting to be an insurance salesman. And back in the 70s, there were really two types of life insurance. There was term and whole life,
right.
Both premium driven. You buy, you die, it pays. End of story.
Yeah, right.
Now you have contracts that you could argue are actually better than what were being provided back then, but there's some non-guaranteed elements. It's dependent upon how the cash value is built.
Better in some ways.
Yep.
Yeah, but not necessarily in all ways.
You might have more upside growth potential,
There you
cash
go.
value, and death benefit, but maybe not the same floor of guarantees.
Right.
So one of the things that I recommend is that if you're looking at these types of contracts, at least, I don't care what you have, if it's a life insurance contract, you should be reviewing it at a minimum every 5 years.
Right.
Now, if it was that VUL that you and I talked about earlier, you should be looking at that every
VUL means
year.
variable universal life, where it's invested in stocks and bonds rather than a fixed kind of account.
Exactly.
Yeah. Okay.
And it's not that hard for the agent to do. There's one of the things you should ask for is something that we call an in-force illustration. In the industry, that could be called an in-force illustration, an in-force ledger, a reprojection. It's basically a snapshot of where you are today, and based upon our current interest rates and the current cost of insurance for the company, where is that looking to go in the future?
Right.
It's not saying that that's a guarantee. It's just saying based upon where we're at today and everything remaining the same going forward, this is what it would look like. Ask for those things.
Right. And so here's a dilemma that a lot of people face. I come upon clients all the time that say, well, I've got this little life insurance policy, and sometimes it's not that little, but the agent is gone. And how do I get this? Well, what we do for our clients is we get that company on the line, usually in the toll-free number in their headquarters, and we order that in-force illustration for them. Now, that means that we can't give them all the answers right that day. We have to get together in, usually a couple of weeks But these things are available for people. So if you say, yeah, that sounds like a good idea, I don't know how to do it, go see your financial professional, and in that meeting say, will you get me an in-force illustration on this policy I've got? And if they say to you, by the way, well, that's not our policy, get yourself a new advisor. Because frankly, a good financial planner is going to help you with the whole picture, not just those things that happen to be invested or taken out with them. So I know that sounds a little black and white, but in fact, if they're not willing to help you with that other piece, then that's a pretty limited relationship.
Well, and every insurance company is required by the state law to provide that information to its policyholders, so it should be something that you get every so often.
Okay, well today, Todd, we've been talking about, we called it wealth transfer, but in fact it's not necessarily for the wealthy, and most of the people listening today would have some avenue in which to do the techniques we talked about, and that is organize their financial affairs in such a way that they are considering what tax bucket they're in. Tax now, tax later, tax never, and how to go about doing that kind of organization, as well as what are some of the different uses of life insurance. Anything you would add as closing remarks for our listeners to take away here today?
Dream it up. If there is a certain way, if you could create the best way to leave your legacy to your kids, grandkids, church, or charity, start thinking about that today. Put it in paper and work with your financial professional to actually get it done.
Absolutely. And our free offer you can get at 1-855-346-4332, and we will send it out today, or we'll send it out this week, and it is called Cover Your Bases, Focus on Protection Planning While Helping Achieve Retirement Goals.
Scott and Todd, thank you very much for joining us in studio today.
Thank you.
Thanks
I had
so
a blast.
And Scott, we'll see you next week.
Absolutely. Looking forward to it.
Thanks to all of you listening for joining us. Hope you have a great week. An Indian summer kind of weather ahead all around the state, so get out and enjoy that. And make sure you tune back in next week for Financial Strategies with Scott Wardell. We'll see you next week.
We hope you've enjoyed the past hour of Financial Strategies with Scott Wardell. While various products may be discussed during the course of this program, please note that these discussions are intended only to educate you about financial topics. They are broad in scope and do not consider your individual personal financial situation. You should work with a qualified financial professional in collaboration with your attorney and tax advisor before implementing any financial decisions which will affect your personal financial situation. Thrivent financial representatives cannot provide legal or tax advice. Your local Thrivent representatives are Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731. Join us again next week for Financial Strategies with Scott Wardell on KMRS Morris.